today we are going to be talking about risk management and some trading
This is
strategies.
not financial advice.
Pardon? No.
This is not financial advice.
Right, this is not financial advice, and this is just something funny that I found. So we can talk about risk management all we want and trading strategies, but sometimes if you look at this graph, you could have made $500,000 just by putting your 3 stimulus checks towards Dogecoin. Now obviously that's not good advice, so today we're going to talk about how to properly manage risk. And before we do that, let's do a review. We have some review to do. So for my PowerPoint, I put up, a review, okay. Let's have a quiz. Shorting, what is shorting? Let's go with Nagar. What does it mean to short?
It's like when you bet against the stock, instead of going long, you bet that the value of the stock will go down. So you kind of borrow it, and then if the price goes down, and you bought it at you bet against the market, so you make some money off of it.
Okay, good. Futures. Shreya, what is futures? You might not have been there for that day, but tell me, what is futures? Anyone know futures? Igor, you should know futures. What are futures?
This is a contract. You use a court example, if I remember correctly. So you agree upon a deal based on what will happen in the future.
Mm-hmm. Right, so it's an agreement that you draw up with someone that you agree in the future date to transact something at a certain price, right? What about options? You do this one. What are options?
Okay, so they're basically they're like 100 times leverage and like aren't they? Okay, so like a call option is where like if the stock hits a certain price plus like the initial like commission you have to pay, then you like start profiting, and like the graph is like this, or like in.
What is it though? What is it? So it's an agreement,
It's
right?
an
It's
option to
agreement.
buy a stock at a certain price.
Or sell. So depending on call or put, right? You buy the option, it gives you the option of buying a stock or trading a stock at a future at a certain price, right? What about credit default swaps? Monica, what was credit default swaps?
That was like when you buy insurance on an insurance company or something, and then like if say like there's a house and the house has insurance, and then there's like a third party who's like, oh, I think that house is gonna burn down, I'm gonna buy insurance on the insurance company or something like that.
It's when you buy insurance on debt. So in case someone doesn't pay your debt back, right? The insurance company will pay you instead. So you're insuring a debt, right? All right, let's get started. Oh, okay. That's a picture of Bill Ackman. So if you remember from our first day, we did something called beta. Does anyone remember what beta is? And then I did some complicated math equations on the board. Do you remember beta? Who remembers beta, right? So today we're going to do a little bit of mathematics and talk about what the beta equation really is. I did talk about it on the first day, but I think it was a bit confusing. So to simplify it, it is the covariance of the market and an individual stock divided by the variance of the market. And now what that means, covariance, it's a measurement of how two things are correlated, right? If you look at here, so this xi means each x term, right? And then the x with the little hat means the x average. And then the y, it's one y term minus the y average, right? So if you think about it, let's say the x represents the market, and the y represents an individual stock. So what this is telling you is that if x and y moves in the same direction, they're multiplied by each other, right? Do you get a positive or negative number? If x and y are moving in the same direction, they're deviating from each other, they're deviating from their mean in the same direction. So up here, do you get a positive or negative number?
Positive.
Positive. Why is it positive?
Well, they're moving in the same direction, and like
Yeah.
if they're moving in the same direction, like I think regardless of the direction, it will equal a positive correlation.
Yeah, so let's say your x average was 1, right? And your y average was also 1. If you're moving in the same direction, let's say to 2, right? 2 minus 1 times 2 minus 1, you get a positive number. The only time you get a negative is when you start moving in a different direction, right? And also this measures magnitude, because if x is moving a lot in one direction, and y is also moving a lot in one direction, you get a really big positive number, right? And then, so this is covariance between RP and RB. I think RB stands for the R base. So beta is a comparison between two assets, right? And then what you do is you sum it. So this is sigma notation. Anyone learn sigma notation? I think you guys should have learned sigma notation already. And what you do is you add each of the terms up, right? And then you divide it by the variance of the market. So what that means, the variance of the market represents the volatility of the market. So let's look at it this way, right? So if you have the S&P 500 here, which is what the beta is based off of, because beta is a measurement of correlation between two stocks, right? And usually it's a stock correlating to the market. So let's say this is the S&P 500, and you have another stock here that looks something like this, right? So do you think the upper part will be positive or negative? This here, the covariance, sigma of these two, are they positive or negative? Nagar, why is it positive?
Because we're moving in the same direction.
Right, they're moving in the same direction. It doesn't matter. If they're both going down, then you get two negatives, right? And then you times each other, it's still positive. So because they're moving in the same direction, you get a positive number. Now, variance of the market, which is the volatility of the market, right? It's the market, which is the S&P 500. Do you think it's more volatile or less volatile than the this stock? Let's call it Costco. Is it more volatile or less volatile? I'm gonna go with Janet.
More.
Yeah, it's more volatile, right? So the market's more volatile. What that means is this thing down here will get bigger, right? Now, as you can see, beta is inversely proportional to the bottom term. What that means is the bigger this gets, what happens to your beta if this thing gets bigger? It gets smaller, right? They're inversely related. So if your market's more volatile and you're correlated in the positive direction, what ends up happening is, what's the beta of this then? What would the beta be? You don't need an exact number, but what would it be around? So let's start with this. Is beta positive or negative? So we define it as positive. Is it more volatile or less volatile than the market? So would it be greater than 1 or less than 1? So beta is less than 1, right? But it's positive. Now let's say if the market changes. Now let's say for a moment, if the market starts looking something like this, where the market is less volatile than the red stock, right? Let's imagine purple as the S&P 500 for a moment. What ends up happening to your beta? Does your beta get bigger or smaller?
Bigger.
Why does it get bigger?
More volatile.
Why? Kai, why? Why does your beta get bigger now that the market is less volatile? And refer to the equations here.
So the beta is getting bigger
Why?
because it's more volatile in the market.
Right, because if the market gets less volatile, right, this term gets smaller. And if this term gets smaller, then your beta gets bigger, right? So it's a comparison. Beta is a comparison between volatility. So let's erase this right now. And let's say, here, let me find a different company. I have another one. Okay, so let's say this represents a company that looks so let's call this company 2-0. Do you think the beta here is positive or negative? Let's start with that. Yes.
It's negative because when like the market like trends upwards, it goes down and then vice versa.
Yeah, so as you can see, when the market, which is represented by black here, when it goes up, this thing goes down, right? And when the market goes down, this thing goes up. So it's an inverse correlation. And what would happen here is that these terms will get a positive times a negative and a negative times a positive, right? So you get a negative term up top, and then divided by the volatility of your market. Does this make sense? For a bit of a beta review. Nagar? You're laughing? Oh, okay. Did you learn this in the end of your class?
No.
Stat, right? So for variance and covariance, did you learn stat?
We kind of did variance, we did a little bit of it, but not really like the beta stuff.
Okay. Next slide. The concept of margin. So, does anyone know what margin means? What does it mean to be on margin? Here. What does it mean to be on margin?
Okay, so I think margin in this case would be like borrowed money. And
Okay,
like,
keep going.
and like it's dependent on how much like assets you have like shorted or like longed, and then like usually once in a while there's like a margin call, which like if you don't have enough money, they'll like take the stocks back because
Okay, let's talk about margin. So margin, it's borrowing money to make a trade, right? It's when you borrow money from your broker to make a trade, and it gives you this thing called leverage. Now, leverage means how much money you have on your own and how much money you're controlling, right? So for example, if you have $100 and you buy an options contract that gives you control of $1,000 in shares, right? What would your leverage be?
10 times.
10 to 1, right? You have a 10 to 1 leverage. For every dollar that you have, you are controlling $10 worth of assets. So let's talk about how margin works. So let's say we have our guy here, right? Who has $5,000 of his own money. And there's a stock here that's worth $100. How much shares can he buy? Monica, how many shares can you buy?
Sorry.
So you have $5,000.
Yes.
Each stock is $100.
Oh,
You can buy 50 shares, right? But let's say his broker offers margin, which means his broker is willing to lend his money. So let's say we have your broker here, right? And the margin requirement, it's something that's mandated by the feds, by the government. It's saying how much money you can borrow. So let's say your margin requirement was 50%. So how much money can this guy borrow if the margin requirement is 50%? Sure. 50% margin requirement means 50% of the money has to come from your own. So 50% of the trade, right, has to be your own money. So how much money can you borrow then?
You can buy 100 stocks, right?
Hmm?
You can buy 100 stocks, right? Double what you
Yeah. So you can borrow $5,000 from a broker. So now you can buy 100 shares, right? What would your leverage be right here? Yeah.
2 to 1.
You have a 2 to 1 leverage, right? So let's talk about what margin means. So let's say this right here represents your stock, right? So you buy the stock, it's worth $100 right now, and you buy 100 shares, right? So $5,000 of it was your own money, and your broker gave you $5,000. So $5,000 are borrowed. Now let's say the stock goes up to $110. What happens? Janet, what happens when the stock goes up to $110? So let's say it goes up, right? So let's say this is $100. Let's say it goes up here to 110. What ends up happening? Janet?
You have more assets,
Pardon?
like you have more.
You have more money now, right? So now, you still borrow $5,000. But this thing here, how much is it worth if it goes up to 110? It's 6,000, right? You get $1,000 in profit. And also what that does, it's now look, you have a buffer, right? Because when you're on margin, what you're doing is, look, so let's say I'm on margin and Ryan's a broker, right? So what I'll do is I'll go to Ryan, I'll say, hey, I'll borrow this money, right? And as collateral, I'll put my shares as collateral. So the stock represents a collateral, right? So you must maintain half of your assets as collateral. So now look, your assets go up, you have more collateral now. What does that mean? If you have more collateral, what can you do now? Because you need to maintain 50% margin requirement, right? Mm-hmm.
Does that mean you can like borrow more money?
Yeah, you can borrow more money now, right? Because you have more collateral to put up. But now let's say a different scenario happens. Let's say the stock goes down to $80. How much money does the broker lend you? Well, you wrote it down. It's still $5,000, right? The broker doesn't care how much money you have. Whether your stock goes down, up or down, they still lend you $5,000, and this is how much money you owe them, right? But look, how much money do you have right now? If it goes down to $80, huh?
3,000.
Good math. $3,000, right? Now, Ryan talked about something called a margin call earlier. What happens right now? So you have $3,000 in collateral, and you borrow $5,000. Let's go to Igor. What's happening right now? What happens?
You have less than 50% collateral.
Mm-hmm. And the margin call, what happened? No, what's margin call?
So like the brokerage will like steal $2,000 worth of your stock, because obviously it would still have like 50% of the money being yours.
Okay, not yet. So what happens now is you get a margin call, right? What a margin call is, it's basically your broker telling you, look, you're below the margin requirement because your margin requirement is 50%, right? And now you're below it. So you have to find $2,000 and put it into your fund within 24 hours, or what ends up happening is you'll start selling your stock until your margin reaches a 1-to-1 ratio, right? And what's so bad about margin calls, it's that, look, you either gotta find the money to put it into your account, which forces you to sell other assets, right? Or if you can't find the money, they'll sell your stock right now at a loss at $80, right? And this is exactly what happened to me. So if you guys remember, back in January, I shorted this stock called GameStop, right? And so I shorted the GameStop at $40. Now when you short, are you on margin when you short? Nagar, do you think you're on margin when you short a stock?
It's like more risky, right? Because you lose a lot more, so.
So are you on margin though?
I guess not.
Pardon?
No? Yes, I.
Okay, so actually when you short a stock, you are on margin because you're borrowing the stock, right? So you're borrowing something from the broker. So I shorted at $40. So I shorted, and the maximum we can short is $200,000, right? That's the rules of our game. So I shorted 200K worth of it. And then all of a sudden, the stock went up to $400. So at $40, I owe my broker 200K. How much money do I owe them now?
A lot.
How much is a lot? I actually owe them $2 million. So I owed them $2 million, right? But there was only $1 million in my account. And here's the thing, our game is a closed game, right? You guys know what I'm talking about, right? This game that we're playing here. None of you guys are making money.
Well, that's because you're at the bottom like 10 people.
Huh?
You're at the bottom 10 people in the game.
Are you making money?
You used to.
Okay. Anyways, look, I got margin call, right? And what happens in margin call is we're in a closed game, right? There's no way for me to find more money. You can't add money into the game. So what happened? If I can't find money and I got margin call, what happens? Hmm? Yes, what happens, Guy? If you're a margin call, you can't find the money, what happens?
They sell it and you lose.
Yeah, they sell it, right? So Investopedia automatically covered my shorts at $400.
Oh.
So even though the stock dipped back down to $40, right? It doesn't matter. They forced me to sell at a loss because I couldn't find the money. And as you can see here, this is me, minus 95%. But yeah, let's see who else is on here. Leo's on here. Kyan, why are you here?
I don't know. I haven't checked it in a while.
That's okay. Okay. Oh, the Great Depression. Do you guys know what caused the Great Depression? Part of the reason? What's part of the reason? Yes. Guess what this slide is about? Look what it's about, right? What do you think could have happened to cause a Great Depression? Yes.
Wasn't like either the country or something was on margin from others?
Yes, it does have to do with margin, right? So during the roaring 20s, people started leveraging up and buying stock because they were borrowing money to buy stocks, and that created a lot of leverage, right? But what that means is that once the stock falls, you're falling so many times harder, right? So let's go back to our 2-to-1 example. If I'm levered 2-to-1, how much money do I have to lose to go bankrupt?
50%?
Right, if you lose 50% of your money, you go bankrupt because you're leveraged 2-to-1, right? Whereas if you weren't leveraged, you need to lose 100% to go bankrupt. Now let's say if you're leveraged 10-to-1, 30-to-1. If you're leveraged 30-to-1, how much money for you to go bankrupt?
0.33 repeating percent.
No, 3%.
Oh, fine.
3%, right? If you're leveraged 30-to-1, a 3% fall in the asset will cause you to go bankrupt. Now, let's go to the last one. How do we avoid margin calls? Got it. Don't. Don't borrow money. So that's smart. First off, don't borrow money, right? Which I hope none of you are doing right now. Trading on margin. Are you trading on margin? No, right? Yeah. So one, don't borrow money. If you do want to borrow money, how do you avoid margin calls?
Risk management.
Risk management, right? So like what? What can you do to avoid a margin call?
I don't know, I thought this was like a segue into like your lesson about risk management.
Almost, yes, you're right, yes.
Like only invest a small portion into like margin so you can like cover it easily.
Yeah, like look, before, right? I was at my maximum margin requirement. Don't do that. Don't max out your margin. Because look, what I'm saying is, if I'm maxed out at 2-to-1, right? A fall in 1% will make me get a margin call. They'll say, hey, you have 49% of margin requirement, you're getting margin call. So what you should do is you should stay below your margin requirements. And as Colin said, we're going to segue into our talk on risk management. And for every slide, I put up a hedge fund manager, right? And whoever names all of them, I'll give you an exec spot. Okay, how to protect against shorts. Okay, so this one is talking about how do you protect against getting margin call, right? So how do you protect against short position? And we're going to talk about the concept of hedging. Does anyone know what that means? So I've talked about hedge funds a couple of times. What does it mean to hedge? Asia, what does it mean to hedge? Monica, what does it mean to hedge? Hedge. Igor.
Isn't it a hedge fund or just a hedge?
Hedge. So hedge fund, right? What do you think that name comes from? What does it mean to hedge?
It's a bunch of people putting all their money into one fund.
No, very wrong. Yes.
Hedge like avoid, like if you use like hedge your bets, like it's like be careful.
It's like risk management, right? It's a way to manage your risk and protect against your downside. So let's go back to the GameStop example, right? So let's say we have GameStop right here on this axis. And it's currently trading at $40, right? And you want to short the stock. All right, so if you want to short the stock, you're betting that it will go down, right? So let's say we have two scenarios. In scenario one, you are very wrong. The stock goes up to $400. This is scenario one. And in scenario two, you are right. It goes down to $10, so you make money, right? And let's talk about what these scenarios would mean. So let's say you short 100 shares of GameStop. So how much money are you shorting if you short 100 shares?
40,000.
40,000, right? So you're shorting
100 shares.
$40 times 100. So you're shorting
$4,000. Yeah.
40,000, right? So let's say in scenario one,
What?
What?
pardon?
Yeah, it's 4,000.
4,000.
40 times 100, right, it is, right? So you short $4,000. So you're shorting $4,000, right? And let's say in scenario one, short, and total losses. How much money would you be making from scenario one?
You're losing money.
How much do you lose? So you borrowed it at $40, and now it's at $400, right? So you borrowed something at $40, and now you need to buy it at $40 to return back to the person. How much money are you losing?
36,000.
33. You're losing $360 times 100, right? What does that give you?
36,000.
$36,000. So you're losing $36,000. Now, let's go to scenario two. How much money would you be making or losing in scenario two?
3,000.
You make $3,000, which is $30 per share times 100. Gets you $3,000, right? Now, as you can see, you have a very big loss scenario here, right? If you get short squeezed, you're going to lose a lot of money. So how do you protect against, how do you hedge against this bet? Monica, how do you protect against it? It has something to do with options.
Get an option.
Kind?
Like, I don't know the name for it, but I guess you'd get the option to like back out of doing it or something.
What's that called?
I don't know.
Yes.
Okay, so like, yeah, people come use like call and put options to hedge their investments. So like, you can use a call option. So in case it goes up to $400, you profit from the call option, which means overall you either lose less or actually profit from the trade.
Okay, so you buy call options, right? And what you want to do in this shorting scenario is you buy short call options that are way out of money, right? So the strike price, it's way out of the strike price right now. Now let's say you buy, so this is the language that they use. Buy to open means you're buying call options, right? $100 strike at $2. So what is this telling you? Yes?
It has strike price at $100 and it's $2 per contract.
Yeah, so its premium is $2, right? And you buy one contract, and let's say this contract will end up costing you, how much would it end up costing you? $200, right? So it costs you $200. So let's say in this scenario, right? Let's go back to scenario 1. So you have call options that are strike price $100, and they cost you $2 to buy. So let's go back to this scenario. In scenario 1, you lost $260 per share times 100, but how much money would we make from the call option? So strike price $100.
300 times 100.
Yeah, so you make $300 per share, right? Times 100 in the contract. What would your total be then? How much money would you end up losing or gaining?
66
$6,000, right? $6,000. Now let's go back to this scenario. So you gain $30 times 100 shares.
But there's like a commission for like the call.
Don't know the commission. All right, so let's say for the call option, let's say in scenario 2, how much money would you be making now? So the call option, are you going to use the call option? Strike 100. Are you going to exercise? Monica, do you exercise your call option? In scenario 2, right? So the stock is trading at $10. Would you exercise your option to buy it at 100? No, right? So you actually end up losing money. So how much money do you lose? Pardon? Yeah, so $2 times 100, right? So that will be $2,800. And if you actually graph it out, so let's graph this out. Let's see, where can I graph it out? Okay, so I can't graph it out. So what you're doing is basically, you're shorting the stock, right? But your call option acts as like a downside protection. So if the stock goes really against you, you have the call option to cover your trades, right? So, are there any questions before we move on? Yeah.
But like, do the chance you get unlucky and it just stops at $80 or something like that?
They can. So your losses are actually maximized at a certain point, right? So the most that you can lose is the stock goes up to $100. That's the most you can lose, right? Because up to $100, you're not going to exercise your call option. But anything past $100, you can't lose more, right? So you can't lose more than $60 per share. Why can't you lose more than $60 per share?
That's the difference between your option strike price and your current price?
Yeah, because if it goes over that, you have the option to cover it, right? Okay? Are there any other questions? Igor, I have a question for you. What does this look like? This risk-return ratio right here. So if you were to graph it out, right? So let's say you graph your profit and losses right here. This is your P&L. If you just, and this is the underlying, right? So let's say you're shorting here, and it's at $40. What would the graph look like if you're shorting? What would your profit and losses versus the price look like? Igor, come on. You're in the exec, aren't you? Negative, right? So it goes like this. Because for every dollar the stock goes up, you lose $1, right? Now, let's say your call option, P&L. And the underlying price. What would it look like? So your strike is at 100. This one's harder. Ryan, answer this one.
Okay, so it's gonna be like slightly, okay, for like before 100 it's gonna be slightly below it, and then like once, and then from 100 it's gonna go to 102, and then like continue growing.
Yeah, so it's going to look something like this, right? And if you actually combine these graphs, what do you get when you combine these graphs? So let's say this one is your short, right? And this one is your call. Now let's say your total P&L. What is it going to look like? Well, it's going to look something like this. So everything from here, right, you're making money. And everything from this point on, they actually cancel each other out. So it goes flat. What does this look like?
Put option?
Huh? Yeah, it looks like a put option, right? So basically, shorting a stock and then buying a call option to hedge it, it's very similar to buying put options, right? Does that make sense? Okay. let's see. Oh, anyone know who this is? Who is he?
Warren Buffett. I don't know.
This is Warren Buffett.
I don't know any other
Who is this?
Same.
Hmm?
Are those like two different people or the same person?
They're the same guy.
Is this the French billionaire?
Oh!
First one looks so
You know what he's doing here? What is he doing here?
teaching.
Huh?
I thought he was eating or something.
Yeah.
Look at this. What do you think he's doing here? It's like this law thing. What is it called? Deposit. Not deposit. What is it called? When they interview you.
Called to the bar.
No, deposition. He's getting deposition for insider trading here. So this is Steve Cohen, which is one of the people who went short on GameStop. Okay, so now we're going to segue into risk management. So we're going to talk about the 4 types of risk. Idiosyncratic risk, that's your unsystematic risk, right? That's risk that is specific to a company or a sector. And the market risk, this is risk that is subject to the broader market as a whole. And then the last 2 are kind of smaller, so foreign exchange risk and inflationary risk. So let's start with idiosyncratic risk. What is idiosyncratic risk? Well, idiosyncratic risk is risk that's specific to a company, right, or a sector. So we talked about this broadly during our second lesson where I talked about how to hedge against idiosyncratic risk. So let's go Australia. Give me one example of an idiosyncratic risk. So let's talk about the company Apple, right? What's an idiosyncratic risk or a risk that is very specific to Apple?
Their products do terribly.
Yeah, so their products do terribly, right? What else? Let's talk about a company's idiosyncratic risk to the phone industry.
What?
A risk that is specific to the phone industry.
Bootleg versions?
Pardon?
Like bootleg versions?
Bootleg version, sure. So no one buys your phone, right? And now we're going to talk about a concept called expected value. Do you do this in math? Agar? Expected value, right? We talked about expected value briefly. So expected value, it's a mathematical way of calculating how much each bet is worth, right? So if you, let's say there's this game that lets you have a 100% chance of winning $5. What is your EV for this game per play? Expected value per play. Yeah, because every time you play this game, you're expected to win $5, right? Now let's say you have a 50% chance of winning $100. What's your EV then? Trey, what's your expected value for this game?
$50?
$50. Why?
No, I would get 100, or you can get nothing.
Yeah, so what this is telling you is you're expected to win this game once every 2 play, right? And every time you win $100. So let's have this game here. Let's come up with a game. This game will be a coin flipping game. Okay, so let's say we have a coin flip here. So we have a coin right here, right? And let's play a game. So I'll play this game with Nagar, let's say. So you need to invest $1 into this coin, right? Every time you if you win $3. And if you lose, then you just lose your $1 that you invested in, right? What would your expected value be for this game? So let's say it's a fair coin. You have a 50% chance of winning. It's not $2. So let's start. Expected value, it's your odds of winning times the winnings amount, right? So let's say you have a 1/2 chance of winning. Every time you win, you actually only win $2 because you invested $1 to play the game, right? So what's the expected value? $1, right? So every time you play this game, you are expected to win $1. Now, would you bet your entire life savings into this coin?
No.
Wow.
You're saying yes, why? Why would you bet your entire life savings into it?
I don't know, I don't
I mean, I don't have
Mm-hmm.
I mean, I guess because the expected value is earning $1, and the more you put into it, the more it goes into the average, I suppose.
Okay, so let's say this one game, right? This one try. So I have a coin right here. Would you bet your entire life savings on the coin?
No.
No.
Seeing it's just $40,
It's not.
yes.
While
I mean, why not? You have a positive expected value. Kai.
Like, do you mean like you play $40 to play one coin flip?
Yeah, so let's say you have $1 million, right? You bet that $1 million on this coin flipping heads. Why not? If you win, you get $3 million though. And your expected value is positive.
But you only get to play once.
Yeah, you only get to play once. So, in this scenario, right, if you bet your entire life savings in it, what's your chance of going bankrupt then?
50%.
You have a 50% chance of going bankrupt. So how do you hedge against this risk?
Don't play it.
Fine.
Can you
Don't
like-
play it. Why not? This is a positive value game. You're expected to make money.
Can you like do like separate coin flips, like $1 per coin
Yeah.
flip?
You could do 2 coins
These
flips, I
separate
guess.
ones.
Yeah.
The point is, you want to play this game as many times as possible, right? Because look, if you flip this coin twice, what's the chance of you going bankrupt?
Like
25%, right?
Yeah.
If you flip it like 10 times, what's the chance? 1/2 to the 10.
0.5 to the yeah.
1/2 to the 10, right? So the more you play this game, the less likely to lose. So let's talk about casinos, right? So for casinos,
Oh,
There-
it's very rigged.
so let's say you have a game here, right? Like roulette. For example, if you have roulette, let's say the expected value for the player. Are you expected to make money from playing roulette? Sure. Let's say you go to the casino to play some roulettes. Are you expected to make money?
I don't think so.
No.
We should.
So if the expected value is positive for you, what does that mean for the casino? If it's negative for you,
They're positive.
so fine, Igor. So it means it's positive for them, right? But here's the thing: the casino will not bet their entire bank account on that one game. Why not?
Or else their whole company would just be
Yeah.
gone. And like,
Yeah. So it's a law of large numbers, right? Instead of betting your entire life savings into one game that you know you have a good chance of winning, what you should do is you should spread those bets out, right? And that's the same thing with stocks. So if you have a stock that you know has a good chance of making money, you don't want to bet your entire life savings into it because you could be wrong. So what you want to do is you want to spread it out, right? And like the coin flip example, instead of flipping that coin once, and let's say you flipped it 10 times, or 5, right? Now your chance of going bankrupt is 1/2 to the 5. And your expected value from this game is still positive, right? So here, it's something that we have. So in the coin example, what would your correlation be? What is the correlation between coins? Think about it, right? If I flip a coin, does the current flip affect the next flip?
no,
No, right? So what's the correlation?
it doesn't.
0%. The coins are zeroly correlated, right? Now let's say the coins have 100% correlation. Does diversification matter then? Does flipping the coin 10 times, would it be a difference or no?
Then there's-
100% correlation.
Then there's no point.
There's no point, right? Because everything after the first flip is dependent on it, right? Everything acts the same way. And which is what you can see here. So look, on the bottom, it's the number of assets you have in your portfolio, right? So at this point, you can think of this as the number of times you're flipping the coin. And this side is your risk, your standard deviation. What is the odds of you losing money? And as you can see, the more assets you buy, right, the lower your risk. And the green line and these lines, they represent the level of correlation, right? So the green line represents 0% correlation. And the red line represents 60% correlation, right? So what can you tell me about this graph? Let's go, Janet. What can you tell me about this graph?
Buy more different types of
Yes.
stocks.
Sure.
Diversify your portfolio, since if you have a great number of stocks from the same sector and that sector goes down, you're losing more money. But if you have some stocks for one sector, some stocks from another sector, you can cover your losses by profits from the other sector.
Yeah, now, what can you tell me about the colors, the correlations? What do you see from the correlations?
Risk doesn't change with, well, it decreases with correlation. It decreases with correlation, so if there's a high correlation, the risk stops at a certain point, but if it's lower, it can decrease.
Yes.
That's basically the same.
Yeah, so what this is telling you is that the more correlated your stocks are to each other, right, the less diversification it's going to do. For example, if let's say you buy 10 phone company stocks, right, and the phone company does badly, well, your companies are correlated together. So even though you're technically diversified, your stocks are going to go down together, right? So that's just why if you want to hedge out or mitigate your idiosyncratic risk, you can do it through diversification. Are there any other questions before we move on to the next risk? No, okay. So the next risk is market risk. What is market risk? Actually, let's go back. Let's go back to here, right? Why can't you diversify your risk to 0 for 0% correlation? What does this represent? These bars here. Nathan.
There's like still a chance that something would happen that affects all of them.
Yeah, so it's a market risk, right? This right here, this bottom represents your market risk. So the market might still crash, right? Now, let's talk about how do you get rid of market risk. Now, market risk,
You can't. Or it's
Don't.
very rare.
You don't.
How?
Well,
don't.
it could just be a black swan event, and then like you could just.
okay, so there are actually ways to protect against it. So let's talk about market risk, right? It often includes unforeseeable events. So what's an unforeseeable event?
Pandemic.
Pandemic. No one could have seen that coming, right? And it's something that affects the entire market. What else could be a market risk? What's a black swan event? Sure. What could be a market risk? Something that affects the broader market as a whole that you can't see coming. There's so many. War, right? If a war happens, you can't see that coming. That affects the entire market. Pandemic, or a terrorist attack, right? So, how do you protect against market risk? Yes, you were?
Don't you bet against the market?
You bet against the market, but what if you're wrong? What if the black swan event, it's that something great happens, and the entire market goes up and you bet against it?
Well, then you're screwed.
Right, so how do you...
Become a cyclic.
Pardon?
Become.
Or you can just.
Okay, so let's talk about market risk, right? So let's say we have a company here called Honda, right? And this is how much money it's worth for the stock, and this is the time, right? And then we have another company here called Tesla.
Technology.
Long.
Now let's say you are a researcher, right? And you find out that Honda, it's a great company. Honda is going to come out with a great vehicle next year that's going to blow everyone's mind. And what happens when they come out with that great vehicle?
It fails.
Pardon?
It fails.
No.
But some people are already anticipating it.
Hmm? It's not insider trading. Let's say it's not insider trading, right? Or let's call it insider trading. Right? So you have inside information that Honda stock is going to go up next year. Right? So you decide to buy Honda stock. But again, what's your market risk? There's risk here, right?
Yeah, a semiconductor shortage or something.
A semiconductor shortage. Well, let's say people decide they don't want to drive cars anymore, right? So let's say Honda stock is currently trading at $100, right? And you think in scenario 1, it's going to go up to $200. So what do you do to hedge against market risk? It's already written up here. Long short. What does that mean? The long short technique. And let's just say, okay, so I'll talk about the long short technique, right? So you go long on Honda, and what you do is you short Tesla. So let's say I think Tesla, it's a shitty company, right? They're gonna do really poorly next year. But in scenario 1, let's say in scenario 1 something really good happens, right? Everyone decides to want to drive cars now. What's going to happen to Tesla stock, even though it's a really bad company? It goes up. So let's say Tesla is worth $10, right? And in event 1, they go up to $15. Now, what could you do in this scenario to hedge out market risk? Right? Actually, no. Let's start with scenario 2. So in scenario 2, no one wants to drive cars. Honda will fall to $80. And in scenario 2, because Tesla's a bad company, it'll fall to, let's see what do I have here, $3.
Oh.
What could you do to hedge out market risk? Yes, Nathan.
Short Tesla. So
Yeah,
that-
short Tesla. And?
So that you would earn the money if it goes down. Buy Honda. So if Honda goes up, you will still earn more money than you're losing on Tesla.
So let's say in scenario 1, scenario 2, right? So let's say you buy, so let's say you buy 1 share of Honda. You buy 1 share of Honda, right? So buy 1 Honda. How much would that cost you?
$100.
$100. And you want to short Tesla by the same amount. So how many shares do you need to short at the
10.
start? Short 10 Tesla, right? And what this is doing is basically, look, your risk doesn't come from the market now, right? You're not relying on market risk. You're relying on your ability to pay companies. So if you buy, let's say in scenario 1, how much money do you make from Honda stock?
200.
Pardon? You make $100 from Honda and plus 100, right? Now let's see how much money do you make from Tesla in scenario 1.
50.
No, you shorted it.
You lose 5 times 10, 50.
So you lose 5, right? What's your total then?
50.
$50.
Wait, what's the overhead food charge for the household?
Pardon? Yeah, so total, right? 100 minus 50. But let's say in scenario 2, everything goes bad, right? So you were right that Honda was a great company. You had inside information that's going to do great. But it doesn't. A freak event happens and the entire market crashes. What's going to happen to Honda stock?
$80.
So how much do you lose then?
$20.
You lose $20. But because Tesla, it's a bad company, right? It's a worse company. It falls even more than Honda. How much money did you make or lose from Tesla?
$70.
Huh?
$70.
Plus $70.
So you still make 50.
What have I done here to get rid of market risk? What have I done?
You like had a long position in one and a short position on another one in the same sector.
Yeah. So what I'm doing is basically the performance of my portfolio is not reliant on the market doing well or not, right? Because no one knows whether the market's going to do well or not. Rather, it's reliant on my ability to pick out which companies are good, right? Because in the good scenario, the good company goes up by a lot, and the bad company only goes up by a little bit, right? But in the bad scenario, Honda doesn't go down that much because they have good news coming, right? It buffers your losses by a bit, so it doesn't go down as much. But this one goes down by a lot, right? Do you see what I've done there?
Yeah.
So here, you don't need to predict what the market's going to do. Instead, you just need to find 2 companies and figure out which one's better, right? All right, let's keep going. Okay, next hedge fund manager. Ooh, anyone know who this is?
The French guy.
It
Like,
looks like
Who's the French guy?
I forgot the first name.
Pierre.
What?
That's not
Which French guy?
that sounds about French.
Who's Jean-Pierre?
No, I just say random French names.
Yeah, as much as it sounds French.
This is not. Who's the French guy?
I don't know.
Which French guy? Oh, are you talking about the Louis Vuitton guy?
No,
Bernard
other guy.
Bernard Arnault.
Yeah, maybe that guy, sure.
Okay, no, this is not that guy. This guy is called
No.
Ken.
Oh, wait, he shorted like the Citadel thing, they shorted
Yes.
GME.
Guess what's his? Kenneth. Huh?
It's fine. I knew who it was.
You knew who it was? Who is this?
Ken Griffin, right?
Yeah, Kenneth Griffin. This is Kenneth Griffin. All right, doesn't matter. He is also someone who went short on GME. He's quite an interesting looking guy. He looks like someone I know. All right, let's go to the next one. Forex risk. So let's talk about the foreign exchange market. What is the foreign exchange market?
Exchanging currencies,
Pardon?
currency exchanges.
Yeah, it's a currency exchange market, right? So let's talk about globalization for a second. So we live in an increasingly globalized world, right? Everything we buy comes from almost another country. Why does that happen? Why do countries trade? We talked about this in our previous lesson about economics. Kai, why do countries trade?
Isn't it like, I don't remember how this works, but countries that are like completely reliant on themselves, like they're more likely to go into poverty or something than countries that like trade. Oh, it's like the burger thing. that you were talking
Yeah.
about. Yeah, it's like say like China's really good at making plastic and the US is really good at making burgers and they can do it for cheaper, but then when they want to make the other thing, it costs a lot. So then they
Mhm.
trade and then it doesn't cost
Yeah, so it's called comparative advantage, right? Each country is good at doing something of their own, right? Like for example, let's talk about Canada. Do you think Canada can make this iPhone? Can Canada make it?
Yeah.
Yeah, Canada can
It'd be
make
more
it.
expensive.
Right, but Canada doesn't because we have very expensive labor, right? So economists say a Canadian iPhone would probably cost you about $4,000 to make. So that's why we don't make it in Canada. We make it in China. And when that happens, is there creates a need for foreign exchange market, right? You need to exchange currency. Like let's say us Canadians decide to buy a Chinese iPhone. The Chinese people don't want our funny maple dollars, right? They don't want our Canadian dollars. They're like, okay, what am I supposed to do with this plastic money that's a queen on it? I can't spend it. So what do you need to do then? How do you buy the iPhone in China?
You convert your money to their currency.
Yeah, so if you want to buy a Chinese iPhone, right, you need to take your maple dollars and convert it into yuan to buy the iPhone, right? But what happens is, it's like you create a risk called forex risk, right? And that's the exchange risk. So let's say we have a little business here. Let's call this Igor's business. So Igor, you have a business. What do you want to sell? Backpacks. So you sell backpacks, right? And let's say Igor is an American business and Igor's backpacks are doing well. So he wants to open a store in Japan, right? And let's say at the current time, $1 gets you 10 yen, which is not true, right? So let's say this is the exchange rate at year one, right now, right? And to open this business in Japan, let's call this the Japanese business. You need 1,000 yen to open the business. So how much money? US dollars.
$100.
So you need to spend $100, right? To turn it into 1,000 yen, so we can open a business in Japan, right? Now let's say 5 years later, your business does well, right? So here's your business again. And now your business is worth 2,000 yen. So you doubled your money, right? But let's say during that time, the currency rate has fell to $1 for 20 yen. So how much money did you end up making?
None.
$0. So here's what happened, right? You can't spend your money in yen because you're in an American business. The point is you want to make money in Japan and then bring the profits back to the United States, you spend it, right? So look, you doubled your money, your business did well, but the currency exchange rate fell. So you end up making $0, right? Now let's say instead of you being unlucky, let's say you do get lucky. Let's talk about business again, right? Here's your business. And now you still make 2,000 yen. The business is still worth 2,000 yen. And now the exchange rate is $1 to 5 yen. How much money do you make?
4 times.
Yeah, so you get a $400 profit. Right? Now, is this scenario ideal for you? Do you want this scenario?
Depends.
Like,
Well, like there are like hedged versions of currency hedged versions of ETFs and non-currency hedged.
So the actual answer is no. Because let's say you're a business selling backpacks, right? You don't want yourself to be subject to the volatility of the currency exchange market. If you're a backpack business, you would much rather go bankrupt because you have bad backpacks, rather than go bankrupt because the currency exchange turned on you, right? So how do you hedge against a scenario? How do you protect yourself against currency risk? Nathan. Starts with an F. Yeah, I'm gonna do it, Ryan.
I think there's like forex futures.
Yeah, futures, right? So here's what I'm gonna do. So Igor, right? You have your business. And what you're gonna do is you're gonna buy futures, say from Ryan, right? And the future is gonna say, 5 years down the road, I get to buy 10 yen from you for $1, right? Or $1 for 10 yen. So you lock this exchange rate in, right? So $1 to 10 yen, this is your exchange rate regardless of what the market is doing. Now let's say in scenario 1, do you make money from that trade or lose money?
Make money.
Why do you make money?
Since the exchange is the same, you
Yeah.
lose money when it's 1 to 20.
So look, here is what it's saying is, you need to spend 20 yang to get a dollar, right? But because you have the futures contract to protect you, you only need to spend 10 yang to get a dollar, right? But let's say talk about this scenario right here. Do you make money or lose money?
Lose money,
Why?
since you only need 5 to get a dollar, but now it's still 10.
Yeah, so now this is what it's saying is, you need to spend 5 yang to get a single dollar, right? But you need to spend 10 yang to get a dollar because you have the futures contract. Now, why would you still do this then?
Because you lose less than if you move the other.
You don't lose less.
No, but if it's the other one, you.
There's less risk.
It's safer.
You pass the risk on to someone else, right? Because if you're a backpack company, you don't want to take Forex risk, right? You want to be reliant on your backpack business. Now let's say, Ryan, it's a Forex company. Why would you take this trade?
Because I'm hoping that like the Japanese value will increase, like the yen will increase in value, so I make money.
Yeah. So what you've done here, right? It's you've passed your risk onto him. And in exchange for him taking your risk, you need to give him your profits, right? So it's basically saying, look, if the yen goes up, I'll pay you. If the yen goes down, then you pay me, right? So you're at a neutral. You pass your entire risk onto him. And then he gets the downside and the upside of that trade. Does that make sense?
Yeah.
All right, for our last one, dollar cost averaging. This is actually something that you can use.
I could.
You do dollar cost averaging. Do you?
Yeah. So like I bought a stock at like $20 ish, and then when it dropped a bit, I bought more. So like my
That's not
average
dollar
cost
cost
of buying
averaging.
is like lowered.
Okay. So let's go through a scenario. So what dollar cost averaging, it's basically what Ryan just talked about, right? It means instead of buying a stock at once, you spread your payments out, so it makes the average cost lower, right? So let's say Ryan, this is Ryan, you get $1,000, right? And let's say you work, you get $1,000. And here's Microsoft stock. Microsoft stock at $100. So let's talk about two scenarios. Okay, 1, 2, 3, 4, 5, 6, okay. So let's say Microsoft stock, this is year 1, right? This is year 1, year 2, year 3, year 4, year 5, right? So let's say Microsoft stock costs $100, and you decide to go with the lump sum method, which means you're going to buy the entire stock at once. How many stocks can you buy?
10.
Hmm?
10 shares.
You can buy 10 shares, right? And let's say this stock next month drops, right? So let's say it alternates between 50, 150, 50, 150. What is the average stock? No, the average price of the stock. What is the average?
100.
Yeah, so this stock is averaging $100, right? It hasn't changed. So how many shares can you buy? You buy 10. What's your total?
1,000.
So you bought 10 shares total in the end, right? Now let's say you have a different method, in which you say every month I'm going to take $200 outside of my $1,000, right? And I'm going to go buy some stocks. So let's say $200. How many shares can you buy in the first month? Dollar cost averaging. Okay, how many can you buy on the next month? $200.
4.
You can buy 4 shares. Oh, now it's 150. How many can you buy?
1.
You can buy 1, right? And you have $50 left over. So now you have $250 for the next month. How many can you buy here?
5.
You can buy 5 shares because you have $200 plus your $50, right? And let's say it goes to 150 again. How many can you buy?
1.
And you have $50 left over, right? So plus $50.
Yeah, so you bought more shares.
So how many did you buy here? 2, 4, 1, 5, 1. What does that add up to? 13 shares. And you have $50 left over. Now, how are you able to buy more shares? I mean, the average price of the stock did not change, right? But how are you able to buy more shares? Shreya, how'd you buy more shares? Say that again?
By waiting to the stock with different prices, if it's eaten out, when it's less, when it costs less, you can buy more and it costs more.
Yeah. So what this allows you to do, it's you set aside a certain amount of money to buy stock each month, right? And when it's lower, you buy more shares. And when the stock price goes up, you buy less shares. Now, one added advantage of this, it's that it's easy, right? it doesn't require any brains to do it. Because first off, you don't need to time the market because it's impossible to time the market, right? And second, it's unemotional. So the whole idea of the stocks, it's that you want to buy low and sell high. Yes, Igor?
So what if we'll apply dollar cost averaging to a stock that's just going up?
Well, if it's constantly going up, then you lose out on it.
So it'd be better to buy gold.
But you don't know that it's going to go up, right? So this method, it's actually really good when you apply to something like the S&P 500. So you know that the graph of the S&P 500, let's talk about it here, right? Can you guys see?
Yeah.
Okay, so let's talk about this as the S&P 500, right? Now generally, the S&P 500 is going to trend upwards, right? Because you know in the long run, the stock market goes up. But in the short run, it might look something like this. Right, so it's really hard to know whether you're at a peak or at a bottom, right? Now, you might get lucky and you buy everything at once at the bottom, or you might get unlucky and buy everything at once at the top, right? What dollar cost averaging allows you to do is make your average cost lower. And second, you don't have to contribute all the money at once, right? Like, what if you don't have this big amount of money all at once, right? Let's say every month you make $200 and then you put it in your stock market. And what that allows you to do, it's at an average out. And second, it's the emotional reason, right? What happens to people is like, look here, people get emotional. When the stock goes down, people might actually get scared. They say, oh my God, I don't want to buy anything at all, right? And when it goes up, they get FOMO. They say, I want to buy everything. So you're actually doing the reverse of dollar cost averaging, and that's because people are emotional. So you're following the opposite philosophy where you're buying high and selling low, right? This takes the emotion out of it. So regardless of the price each month, you're still buying the same dollar mark, right? So when the stock is lower, you buy more. And when the stock is higher, you buy less, which follows the philosophy, buy low and sell high. Does this make sense?
Yeah.
All right. Oh, now who is this?
Warren Buffett.
Warren Buffett. Okay, so this is him working at DQ. Why do you think he's working at DQ?
Good marketing.
Good marketing. Why?
It makes him seem a positive person.
No, he owns DQ. He owns the entire thing. And then this is just a meme I put in there. Okay, let's see. We have one more. Okay. Okay. Oh, okay. One last thing. Inflationary risk. What is inflationary risk? This is the last thing we do before we end. So, what is inflation? Monica, what's inflation?
It's like when the dollar increases.
The dollar increases.
Like the dollar decreases. So
The amount you need. Like the worth of the dollar.
Yes.
Okay, an example is like Bob buys bread each month, right? And like for month one it's $1, but then in the future, like the price of bread would increase due to more people on Earth and like the limited supply. So like the price of bread would increase each month due to inflation.
So it's the value of money going up or down,
Down.
right? So it's going down. There's something called a CPI basket, and that's what measures inflation, right? CPI basket is called a consumer price index. It's like a basket of goods where a typical consumer buy, right? So if in year one, the CPI basket costs $100, and then year two, the CPI basket costs $120, did you get inflation or deflation?
Inflation.
Inflation, right? So what this is saying is, look, a year ago, you can buy the CPI basket, $100 was worth one CPI basket, right? One CPI basket was worth $100. And next year, one CPI basket is worth $120. So what that means is your money, the value of your money is buying less now, right? It's decreasing. So if you've been following anything in the news lately, like economic-wise, what are they doing? What's the United States doing, right?
Inflationing.
Inflationing. They're printing loads and loads of money. And that leads to inflation when there's a lot of money in the system, right? So, how do you hedge against inflationary risk?
Gold and crypto.
Gold and crypto. Are you sure that's a hedge though?
Commodities.
See, here's the thing about commodities, all right? If you want, okay, what's inflation? Inflation is 2 to 3% a year, right?
Yeah.
Commodities move by 2 to 3% every day. So if you're trying to hedge against a 2 to 3% risk per year by buying something that's a 2 to 3% risk per day, that's not really a hedge, right? For example, no one says I'm going to protect myself against inflation by buying Bitcoin. That's not a hedge, that's a bet, right? So here's what you do. You do buy stuff. So here's how you protect yourself against inflation, right? You buy stuff. You
Buy
borrow money.
tangible assets.
Yeah, buy tangible assets or buy everything. Buy stocks, right? Why do you think the stock market has been doing so well? Well, because look, if you want to hedge against inflation, you don't want to keep your money as in dollars, right? Because your dollars, the value of dollars is decreasing. So you want to buy something else. So what you can do is you can actually borrow money. Borrowing money, it's the same thing as like shorting money, right? Because you're borrowing it, you're trading it for something else, and you're hoping to return it later at a lower price, right? And this is actually something that can help you. So if you borrow money at say a 5% interest rate, right? And inflation is 3%. How much are you really paying? So inflation is 3%. This is your interest rate, right? So let's say you borrow $100 at a 5% interest rate, right? So next year you have to pay $105. But inflation is 3%. So what's your real interest rate? How much are you actually paying?
Are they applied at the same time or are they applied like separately?
Separately. 2%, right? You're really only paying 2% on your loan. Because you borrow money. So let's say in year one, right? $100, you could have bought a CPI basket with it. But in year two, the price of money went down. So this money you're paying back actually has less value now. Let's think about it this way, right? If you borrowed $100 at 5% and inflation was 100%, how much money would you be owing them? How much did you make from this trade then?
Negative.
No, you're making money.
Oh, never mind.
You're making 95%. Because look, if let's say I borrow $100 from the first year, right? And that $100 can buy one book in the first year. So what that's saying is I borrowed one book from you, right? In the second year, if that $100 can only buy half a book, and I'm returning $100 to you, right?
You get
So,
$200.
yeah, so I borrowed a book from you, and I only returned to you half a book. So, pardon?
Yeah.
Right. So if you want to hedge against inflation, buy assets. Because that's basically a short on money, right? You're taking low on money and buying something else. You're shorting the dollar. Are there any other questions? Okay, we'll end it here then. All right, thanks for coming, everyone. We'll probably meet 2 weeks from now, and Philip will be back with us. All right, thanks for coming.
Thanks.
Thank you.